Thank you, Steve. Rohit, welcome back to F.A.C.E.
Thank you, Dale, for having me back in a long while.
You were great last time. I'm so glad you got back in touch with me. I remember your work. I was impressed. And I want to thank you for stepping in and, coming off the bench at an important time in market history to share your views. You're definitely a headliner, but I also appreciate that you came in to help us out today in F.A.C.E, Rohit. So I'm just going to let you take it away. What are we looking at? And it looks like something completed. Is that the Nifty?
That's right, Dale. So it's my pleasure to present this. And I think the last time we were discussing, we were in late stages of completing this ending diagonal on Nifty, which is what I was showing. And I also discussed the Nifty 500 chart. So I'll come to that as well. Okay. But I wanted to start off with the Nifty chart. This is, of course, a quarterly chart of the Nifty index, where I've marked a 5-wave advance. Now, this is one of the alternates because it's a pretty long-driven move. There's one other way of really counting this, which I'm taking as my preferred count. But this is how I had started marking it in 2010-11, where I thought that this entire structure here was a triangle formation, and that you were to do a last fifth wave. And so at each point, we've been thinking where exactly that fifth wave will end, and then it really extended quite a bit. And what we couldn't really do here is we couldn't put this inside a channel, which is what you typically expect in an impulsive move. For example, that's what we ended up seeing here. This was very well channeled in the third wave. Even this wave was very well channeled when it occurred. And so this is just something I thought up just right now. Otherwise, if I try marking this 5, it's not very good. So what I ended up doing eventually, and what my preferred count at the moment is something.
Let me just stop you there for a minute. The way you have that last structure labeled, if you go back to the chart before that you had up there. Okay, so to me, I'm old school. That's a rising wedge in your ending diagonal to me, and you have the line anchored where 4 is. Yes. That's the bottom of your wedge line. So based upon old Edwards and McGee stuff, you'd expect 100% retrace of the wedge. So is that your target where wave 4 is on this move?
That's correct. That's what Elliott wave analysis projects, that you go back to the 4th wave of previous degree in the upcoming bear market eventually. So that's definitely a final level where you get.
Isn't that interesting that even old school rules like wedges and reversal formations and Elliott wave, I love when different methodologies point towards the same outcome. It gives me even more conviction about it. So
completely.
If I start talking Elliott, I'm dangerous. Okay, but if I stick to what I learned 30, 40 years ago, and then someone who's a competent Elliottician has the same type of targets, objectives, actually gives me more conviction about what I'm seeing. So
yes, so I completely like that approach. In fact, I use classical technical indicators as well, sentiment readings as well when I'm doing this, including everything like advanced decline ratios and so on. So it's great to see things all come together, and they do at important points.
And look at that volume you have at the bottom of your chart. It just completely exploded on the breakdown.
It completely did. Now, so if I go just one level down, since you mentioned volume, I'll just switch it back to a weekly chart, where you can actually see that explosion started right here in the late stages of this wedging. And you notice that even this last part of the wedge itself looks like an ending diagonal. So this is what made it really interesting, that the E, and this I found this initially I found it in a lot of currency charts, and now I'm increasingly seeing it in equities, that wave E of an ending diagonal itself converts into a triangle or an ending pattern before it breaks down. And so it ends up taking far more time than we really anticipate because it does that. And what we noted here is there was a huge sell-off here. And at this point of time in India, the mid-cap indices, like the BSE mid-cap or the NSE mid-cap 100, all peaked at this point, after which they've fallen around 40% from there. The Nifty itself, which is the mainline front index that everybody watches, did not really crash that much in this sell-off, which is why this volume here is really reflecting the broad market selling off ahead of the index itself.
Where does that
And
wave
then,
4 come in price-wise on the Nifty for a downside
sorry,
target, price-wise?
I
Where's
didn't
that
get you.
for?
Yeah, so that's at
Where?
around 5,100.
Thank you, buddy. Go ahead.
Yeah, so this explosion in volumes now has, of course, happened with the Nifty index itself breaking the wedge line, both in the short term wedge, the long term wedge. And in fact, as I'll move towards the Sensex. So, but before I do that, I was just going to another way of looking at it. And this is the type of chart I think I probably discussed in my last uh, face interview, is that I was looking at this entire structure developing as an ending all the way back from 2009. And the reason to do that is that from this point onwards, I have not been comfortable with the counts of the internal counts of these rallies, because I'm counting them on a daily basis, and I found most of the moves to look like they are correctives in series of threes rather than series of fives. And so I thought, so I had only two options. One was the earlier one, where the series of threes is part of a triangle at this stage itself, or else the entire structure is an ending diagonal all the way from 2009 lows to date, and that would then make it a much bigger structure. Because what I'm thinking also is that this ending diagonal, why it's such a big ending pattern, is that we are actually ending super cycle degree bull market in India, which is, I think it would be a 50-60 year. In fact, it dates back to, I think, the 1930s. There's only one chartist who's actually created that data, and which is Vivek Patel. And his back data would show the extended third wave in India lasted from the 1950s post-independence all the way to 1982. And then you had, then this phase is actually more like a fourth wave on a very long-term chart. And then the fifth wave is really completing now. So I think we're completing something which is at a much larger degree. Which is why I've been calling it an economic winter. And when I call
That's
it an
right.
economic, so in India, most people have not really started to accept the idea that we are in a winter. And and it amuses me because I started writing about it when this triangle itself was forming. And after that, within 6 months of that, most companies that were high on debt have actually gone down since 2010 itself. In 2015, we first time started to recognize non-performing assets. And by the time we were in 2018-19, all the mid caps and small caps peaked out. And so despite we are facing those problems, and our NBFC or non-banking financial sector being hit with serious problems in 2018 itself, we still not come to recognize that this is a major cycle degree problem. So that's the interesting part here. Everybody continues to be bullish and still thinks it's a buy on dips.
How long does winter last, Rohit? Time-wise?
So I have found that it varies from market to market. The most closest comparison people end up making is 1929, which in a stock market terms lasted only for a couple of years. But in economic terms, it may last for even a longer period of time. So how I've
10
come to
years, yeah.
yeah, 10 years. So how I've come to tune with that is sometimes the market may do it earlier, because in the market, Elliott wave wise, we are looking for A, B, and C. And once we complete an ABC correction, the market may have done its job. The economic weakness may sometimes continue till wave two of the next cycle degree bull market, which is why I think in Proctor's book, in the psychology of waves, he says wave two occurs on either as bad or worse economic data. So the news is sometimes even worse at wave two, even though you're making a higher bottom, and which is why it's so difficult for people to latch onto it.
Yeah,
It's only
that's a
in the
very
third wave.
important point, because, when we finally get to a point to where we have some, even a rally to new highs in S&Ps, if you look at a broadening top, I know there are some Elliotticians that say after 2,100 S&Ps, that in the next few years we could trade 4,000 S&Ps, by 2025. It's a different view than most likely what you have. But a lot of people are going to think that everything's okay, get the all clear just because the market stops going down. But the Main Street pain can last a lot longer, even though you begin, equities begin to appreciate. And I rarely hear people talk about that. That's a very important point for people to understand. Thank you.
Yes, there's definitely a big lead lag between price and actual news and sentiment. And probably those divergences is what, as analysts, we try to identify. So the chart I'm moving on to here is, this is the Sensex, and the reason I'm using the Sensex, which is a 30 stock index versus the Nifty, which is a 50 stock index, is it has more history. It was incorporated in 1978 when we only had the Bombay Stock Exchange as the individual exchange in India, and they launched this index. And having this history actually allows us to get more context of what has happened all the way since 1978. So what has happened in this quarter, which is what I'm pointing to here, is we've broken the quarterly trend line, which comes all the way from 1980,
Wow.
touched the 2001 low, and we've actually closed a small amount below this line. So this is a very, very major break. Even the fifth wave, as we see, is actually much slower than the previous waves. We've had pretty powerful moves in all the other waves, but this was a much slower advance, probably the slowest I've seen in the Indian market, which completely fits the idea that the ending diagonal is occurring not just on weaker economic data, but also on slower momentum than the previous wave formations, and has eventually broken the lows. And of course, you can see the same in volumes. Volumes completely dipped during this phase and now are exploding as we can start to break down. So this is where we structurally are. What people are trying to figure out, of course, in the short term is whether we've hit a bottom, at least for the next bounce to start. And for that, I have two alternate scenarios. The first one is this, which is that I do feel that the fall from this top, which is at around 12,246, probably completed a 5-wave decline at the recent low of 7,511. And if I go by that conclusion, I could be looking at two potential outcomes. One is, of course, a regular flat in wave B, and the second is an expanded flat. So I've put both possibilities open, that if it's a regular flat, then probably Nifty does not break around 7,100 or say 7,500. That was the low that it made down here.
Get a higher low for C.
So it makes a higher low than 7,511, right?
Okay.
And then heads higher. The second case is, of course, it does 123% of A or 138% of A, which is typically seen in expanded flats, which would then allow it to retest around the 6,900 to 6,800 low. Now, somehow I do feel this may be a higher probable outcome. And the reason is that there are many charts of either individual stocks or even global indices which look like they have a fifth wave down pending, which could actually push the Nifty much lower as well. And this would also bring us very close to the previous swing low. So I'm zooming out here. The previous swing low is where the last rally started. That's here at around 6,825. So this entire last advance, which started on the monthly or quarterly charts, started from this point, and it's possible we retest that and make some kind of a bottom closer to that level. So I think this level becomes an important point where you can complete something.
Okay, nice look.
Now, the alternate way in which some people would want to count, I'm not completely comfortable, but it does fit what is happening around the world. That is, you have a wave 1, 2, this is 3, and we're currently bouncing in 4, which may be over or may continue to form as an ABC. And then you still have a fifth wave down pending before we can say wave A is complete. The only problem I have with that, at least on the Nifty itself, is that what we mark here as wave 1 on the daily chart definitely does not look like a 5-wave decline, because if this is wave 1, it should be 1, 2, 3, 4, 5. It so far looks like ABC, not just in terms of the count, but also in terms of channeling. You don't have a 5-wave fit. You actually just have 3 waves into a channel and then it bounces back. So not a very good idea to mark this as 1, which is why what I've done is I've taken this high as the orthodox top or the truncated top for the previous run-up.
Like a fifth wave failure?
A fifth wave failure. But in a sense, I wouldn't say fifth, because what I discussed earlier is we're taking this entire structure as an ending. So it's basically wave E. This is wave E, but I'm saying wave Z of E, probably the last corrective structure, ends at this high. So I would probably say Z of E of the fifth, ends here, and then it's not 2. And this is what my preferred outlook is. But this is an ongoing discussion among analysts that, take it as 2, then this is only a 4th. But in either case, I do think there's room for one more decline here, whether it's a B of B or whether it's a fifth wave, which fits with, like I said, if we simply go to maybe global indices, like if I move to the S&P, The trend line from the highs is what we just tested. And
Right.
it does look like possibly a third, fourth, and a fifth could be still developing. So if that's the case, which shows up in some, I mean, there are only few indices, like I looked at the Australian market, that of course looks like it may have completed a 5-wave decline, but there are many others that probably have not. And so if there's a fifth down, I think there's that one more leg lower before we get a final low point, where you'll probably see divergences maybe in volatility or in volume or in momentum itself, which would then give us a clue that the fifth is ending.
Mm-hmm.
Now,
okay.
Once we have that 5-wave decline, and that's the next part of the discussion, how much are we going to bounce back? And after such a big fall, most people don't usually anticipate that, you can go up much. But I've seen, at least in the Indian market, or even if I look at the Dow way back in, say, 1929, the B wave, the first bounce back after wave A, ended up retracing almost 50 to 60% in most cases. So, which is a pretty large counter trend swing once you complete this move down. So it's interesting to wait and watch where that happens, because then you can actually get something worth playing into. So if I do a 50% retracement, you can easily come close to the 10,000 Nifty again once the sell-off is complete. In fact, even if I go back to, say, the 2008 bear market in India, which started a little later than the US, the first bounce back that we got, so that's the example I'm just taking, this one, retraced a little more than 50% after we did wave A down. So wave B did that, and then we again sold off to test lower levels. So you often see that kind of a pullback. I think even in the case of the Dow, I mean, people like to look at the example of this is 1929. You had this first wave A, and you've done a little more than 50% retracement in wave B. Again, here, people would want to know what time does it take, and I've found different time scales. Sometimes wave B can be very fast, and in some cases, as in this one, it ended up taking several months, and whereas wave A itself was just 2 months long. So I'm not able to put time onto the element how long it would take for a wave B to complete, as and when it starts. What I would look for is a 50% or more retracement once we are able to mark a completed fifth wave for wave A on the way down.
Okay, let me ask you this. I don't know if you're prepared for it, but your countrymen really like precious metals. I was wondering if you had any view on the gold and the silver.
Yes, so I will go to that, and I'll look at both gold in the Indian currency terms, and also look at gold in dollar terms, and they can give completely
different pictures.
Different pictures. Yes.
Yeah.
So I'll just have the charts.
Thanks for your flexibility.
So, sure. So this is, of course, I'm looking at the gold chart, which I've backdated up to, say, 1968. I've not gone before that. And we completed, of course, one bull market we all know of in 1980, and then it was A, B, C down. And we've started another bull market, you can see, from this low in 1999. So the way I'm marking it is that this bull market was probably the first wave of a new trend that started on the way up, and the pullback that we've seen from 2011 is a second wave. Since 2015, I've been considering that we've mostly bottomed out. I'm not expecting new lows in the gold price, especially since we formed an ending diagonal here at this bottom.
Okay.
So the way I marked the decline in gold was to consider it as a complex pattern, which is WX. I thought probably Y is done here, but increasingly I'm thinking that I'll probably move Z to this point simply because some of the moves within this range itself are also corrective in nature. It's not very clear that this is wave 1 and 2. What is very clear is this entire rally that we've seen from the bottom in 2018 is a very clear 5-wave advance. So I'm inclined to think that what we've completed here is probably the first wave of a longer term bull market, and we are probably pulling back in wave 2. as far as the dollar price is concerned. So we probably see a further pullback. We may not have completed this pullback. It may be we've just completed wave A. We are bouncing back in wave B, which has
That's what
retraced
I was
almost
thinking.
78% retracement, I think, of
it was.
and we should probably do wave C down. So this is what I would expect. And then once that is complete, I'll probably look for a third wave on the way up. So this is my near-term outlook on at least the dollar price. Now we have a very different picture when we look at the INR price. Just a moment. Okay, now in the near term, the INR price shows a slightly different picture because of the impact of the USD INR itself. So probably I should also look at the USD INR after this.
Okay.
The USD INR has been in a longer term upward trend, and many times in the past, even when I think the dollar price has been in a bear market, say in the 1980s or 90s, because the INR was weakening, the gold prices in India have continued to move higher. So this is when you really look at it long term. So I'm going to, I think I had a chart of the MCX price without all my indicators.
And you're getting a couple of requests for the bank Nifty. Maybe you could wrap it after you're through with this on the metals.
Sure.
Okay.
Sure. So this is the gold price in INR terms all the way from 1977. Okay, the picture that it shows you. So like I said, between even the 1980s when gold was going down in probably dollar terms, you've seen it go up in rupee terms simply because of a weaker rupee. So the rupee has been weakening for a prolonged period of time, and that's where gold has provided a strong hedge. So in that sense, gold prices in INR terms have made an all-time high this year, and the rally does not look complete. Just unlike what it appears in probably dollar terms, it looks like we have a series of 1 2 1 2 1 2 going on, and now you're just beginning to subdivide in a series of 3 4 3 4 3 4. So I think there's still upside in rupee terms. Probably the downside will continue to get limited by a weakness in the currency itself, and eventually I'm probably looking at it going to at least the top end of this channel, the immediate channels, which would put us closer to this is of course a kg chart, so this goes almost to 87,000, which is in so this is 43,000 right now, and we're looking at it going to maybe 88,000 over a period of maybe a year or two or a couple of years.
Okay. There are some people like Jim Sinclair that thinks that gold will be in US dollar terms, 50,000 one day. So we see it in INR terms, and it's already there. Maybe it's foreshadowing what could happen when the dollar finally ends its bull market.
So with that,
you have a view on the dollar?
Yes. So I'll quickly go to shall I go to the rupee dollar?
Sure, yeah.
So I'm looking at the rupee dollar chart. Now this is starting, now see, this is a big history of long weakness in the USD INR. So I would say this is one entire bull market, whether a market has a third wave or a first wave. And then we had a decent, very clear A, B was a triangle, C pullback when India was actually going through a bull market in equities, which is between 2002 and 2007. Now during the 2008 bear market, I think the USD INR started a fresh move up. So I've marked that as 1, 2. It's working itself out in a very, very nice channel. We had the third wave complete in 2013, and then you had this long consolidation, which I've marked as a fourth. So we are now in the fifth wave of this move. And the fifth wave itself, I believe, has started to subdivide because it's not gone all the way straight to the top. The central bank has been intervening and keeping the volatility from really taking off. But the larger trend continues to be strong. So I sense we are now in the third of the fifth. And that itself is now subdivided. So we got the first, within that third, we got a second. And we are right now in what I would say is wave 3 of 5. So we might get a fourth wave pullback at some point of time. Maybe a 38% retracement or a pullback to the daily averages would be fair. A 38% retracement would mean somewhere around 74.20 or so from the current range. And then probably you will head higher in the fifth of this move and eventually cross 80 or go to around 84, 85 is my sense for this particular rally that is ongoing. But when I really look at a long-term chart, there are longer-term channels and if I simply take just this channel, the top end stretches all the way closer to around 100. So I think eventually that's where we'll probably be heading by the time the fifth wave completes.
Nice look.
So when you ask about the dollar, I think earlier in your earlier part of the interview, you was speaking to your guests, and there's some confusion with the dollar index because it's broken both sides of its 1-year trading range.
Yeah.
And so what I ended up doing is I ended up looking at the emerging market currency index, the MSCI emerging market currency index. I hope you can see this. Can you see this on?
Yeah.
Okay.
Got it.
So this chart gives me more clarity because when I zoom out of it, the emerging market currency index went through its first sell-off in 2018. So this sell-off was probably the first wave, which I believe is a 5-wave decline. So it's either 1 or A. And then you had this long channelized A, B, C pullback. And now you've started a third wave down, whether it's 3 or C, and it looks incomplete. So far, within that structure, I think we've done the initial first and second wave. We are within the third 1, 2, 3, 4. So we have still got a lot of room down, I think, for this move to complete. And what this tells me is whether the dollar index immediately moves higher or not, the emerging market currency pairs continue to be under pressure. Probably they'll continue to stimulate by weakening their currencies. All of them are doing it. India just did it last Friday by cutting rates almost 75 basis points. Okay. And so I think this is a trend that's likely to probably continue and will be a pressure point for many of these markets.
Yeah, great look. I really appreciate you being here. Do you have a website, Rohit?
Yes, my website where I regularly write is indiacharts.com.
Why don't you show it so people know how to follow you? Besides your, your Twitter handle is at India Charts, and if you'd like to show your website, you go ahead and do that now.
So indiacharts.com, very simple name, and the moment they come there, they can always see the latest post on top. And then the series of previous posts. Most of these posts here, which you see, the latest ones are free.
We're still seeing a chart. So you probably have to stop sharing and then, to bring up your website, because we're still looking at the global currency index.
Is it visible now?
Yes, now we have it.
Okay, so this is the site. Moment they come onto it, they can see the latest posts that I've made. And there are a series of links to all the free posts that are the latest. So the latest one always shows up on top. Now they can either join the free mailing list by putting in their details out here, or they can subscribe. So what I do is I write every day on all of these markets, my daily update on the wave count on everything from global commodities, currencies, indices and stocks. I cover the entire list on the Elliott wave count and the momentum setups. And I send out 2 emails every day, or else the posts keep going online on the website throughout the day. So people can either subscribe to that, or if they just want the free posts, they can just join the free newsletter and read them online. So those are the 2 ways they can interact with me.
My trading warrior brother, Rohit Srivastava, thank you so much for edifying our community, the F.A.C.E community today, and providing us with some great looks and lots of food for thought.
Thank you, Dale. Thank you so much for having me.
I hope that pips rain down on you and your loved ones remain untouched by this virus.
Definitely.
So really appreciate.
We hope this will be a short-term phenomenon that we all deal with and it passes by, I guess.
Do you have thoughts on how long it's, we're hoping short-term. I bet you really have thoughts on the ramifications and what's going to happen here. You want to share that with us?
I think it has a significant bearing, at least on social mood, which is what we study from an Elliott wave perspective, because people are not going to travel, eat out. A lot of things are going to change in behavior. So it definitely is having that impact and having an impact on the world economy and various issues related to debt that have come to the surface, which you're going to deal for months to come. So that's one part of it. Of course, there's no clue as to how long the virus impact remains. I think everybody's discussed the corollaries with the Spanish flu, and it's amazing so far that in India, at least, we have the number of case counts are still low. Some of it may have to do with more kids coming in for testing, but we are not seeing so much community spreading of the virus. So we've asked the Prime Minister's asked everyone just to sit at home, and that's
Okay.
probably working. So we enter the last two. Everyone's hoping that this 3 weeks of lockdown, and which is purely left to the citizens. So citizens have been told that you take care of your sit at home, and that's the best way to sort this out. And people are doing it religiously out here. So we are
Okay.
hoping that once 3 weeks are done, the case counts are not out of whack, and we are able to sail through this smoothly.
And it's just part of this winter season that we've entered, isn't it?
But it's much warmer in India. So India is really hot. It's like almost 30 degrees to 32 degrees centigrade.
I'm actually talking about the financial winter that you were talking about. This too, this too, this too is part of the winter. So, anyway, Rohit, thank you so much for being here, and I'm going to get you scheduled for June. Later on today, let's touch base. And thanks again. Good trading to you, and thank you everyone for hanging out with us today. We'll wrap up the week with the NFP tomorrow. So remember, no matter what you're trading, if you're short, if you're long, if it's gold, if it's silver, if it's oil, don't just count your pips, count your blessings. See everyone tomorrow. Thanks again, Rohit.
Thank you.
Adios, everyone.